Hi everybody, welcome to another update on Stock Screener. I got a suggestion to take a look at West African resources. This company, I already looked at it last year, January 2022, so it's about 1.5 years since I looked at it. I thought it was fair value at that time, market cap here and basically fair value. So now the gold price has updated to 1920, and the market cap is still between those two lines. So I was right, not a lot of upsides. So now let's look if there is some changes to this thesis. So what do we always do when we look at a company? We should always create a flowchart. NPV flowchart. That's the only thing you need. And everyone should create such flowcharts for any investment, because that's how you see the cash flows coming in. So let's try to do that. This is a gold company, so we have gold price. This is the Australian dollar. Let's look at their share count first. Uh, 1 billion shares. Pretty high share count. Is it right? 1 billion. Let's check. 0.83 gives us a market cap of 850 million. Okay, so it's correct. 1 billion shares. Now the enterprise value, we need to deduct the cash, which is about 295 million. So minus 295 million. And we add the debt. Let's take the total debt, which is 138 million. So that's the total enterprise value of 700 million Australian dollars. Okay. So let's see. Let's create this chart already. Okay, we have the enterprise value. Next up is looking at the production. So last time the production was 150,000, and they should start with 300,000, 250,000, and then in the long run 150,000. Let's see if they could do that. And they got 220,000 for this year. And that's much lower than the estimate. It should have been 340,000. So that's already not good. Below estimate, 220,000. It should have been much higher than 220,000. So they have not hit their guidance. All-in sustaining costs 1175 US. It should have been 900 to 700, right? 900 to 700. Instead, we get 1175. So that's also below guidance. So that's not good. 10-year production target. So 360,000 per year. So they think they can increase the production. Let's see. Burkina Faso is very dangerous because it's next to Mali and Niger. So I wouldn't buy this, but anyway, let's do this NPV calculation. So this is the gold mine that we're talking about. 15-year mine life. $210 lower than estimate. Tax 27.5. Yeah, let's say 30. They will probably increase taxes later on. Some corporate taxes as well. Yeah, we have royalties, etc. And maybe let's keep it at 35. So this is a new production plan. Let's compare it with last year. Clearly, this is much lower than estimates. Maybe we should do it like this. 200. And you can see it should be much higher, but it's now lower. Yeah, and then it will stay around 150. Okay. This is interesting because then we can just add all those numbers in our NPV chart. I like this chart a lot. So 195. Two more years. Like this. And of course, update this here. This should include this and this. Okay, and we can get the same as this. So production we have. Now we need costs. What do you think the cost will be? They don't tell us, so I guess we should use the same cost then. The cash flow should be 100 million after final. Not sure what they mean. But what I get is 180 million income. Okay, so what are the interest payments? Finance expense is 2 million. 2 million per year. I don't believe that. How can it be only 2 million per year? Here it was 58 million. Doesn't make any sense. Interest paid 700. Yeah, it looks like it's around 4 million per year. Not sure. I have no idea. Let's just say 4 million because of this. Because they had debt of 14 million. Actually, the debt is not that high. These are just payables. Tax liabilities. So it could be 3 million indeed. And probably they will repay that debt easily. So yeah, let's take 1 million and then a 0. Capex, that's the difficult one. What will the capex look like? Okay, capital development expenditure 10 million. We don't take sustain out, we have the non-sustaining, that's what we need. 45 million. Because they are constructing Kiaka. That's interesting. Apparently they have a new project. Not sure how much, let's say 45 million times 4. Because this was a quarterly report. This is all in Australian dollars. Okay, so we're taking on debt, 265 million. That's important because that means the interest payments will go up. Let's take 10% of this. That's 26 million. And in AUD will be around 35 million. So actually, let's add 35 million. Because they are going to need the debt. And then they will repay some of that each year. Then it could be 25 million. Like this. Okay, I need to know what this Kiaka Gold project is about. Completion by the end of the year. Do they have anything on that here? Okay, Kiaka Gold. 18 years mine life. At 220,000 per year. %90 ownership. How much was this? Also 90% ownership. Okay, then we need to take income at 90%. So Kiaka. Pre-production capex 430 million. Not sure how much capex is left. Yeah, they still need to do a lot of work. All-in sustaining cost 953 1052. So it will reduce the cost a bit. Let's say 2026, it will be 1,100. And production will be 233,000 going to 200,000. Okay, 233,000. For 5 years. You think that making this flowchart is easy? No, you need to take everything in account. Life of mine, probably a bit less, 210,000. Let's say 200,000. And that's only 1, 2, 3, 4, 5, 6, 7 years. So we have still 10 years to go. Yeah, 10 years to go. This is proving to be a pretty big mine. You know, I don't know where I am anymore. 200. Okay, from here on out, we take the same. But the first mine only had 15 years mine life, so until here. And the second mine will be only 200,000 until here. Something like this. So these are all cash flows that are coming in. Very good. Nice cash flows. That's what I want to see. High mine life with a lot of cash flow coming in. Now the capex. How much capex is left? To be sure, let's just take the complete capex, which is 430 million. Times AUD price, 600 million capex. And then we just add some drilling capex growth per year. I think such gold mine should have around 20 million in growth capex. And then we get this situation. So first they will need a lot of cash outflows to finance the new mine, the Kiaka gold project, which has a lot of capex. Mid 25 in production, good all-in sustaining cost. Of 1000. I like high margin projects. So that also means we need to update our valuation. Valuation for the future is actually this was 700. Now it's 1100. And production is not 150 anymore. And that's a problem. This is the gold production currently. For the future, we will have around 360, 370,000. So for the future, we have this and this. So you can see there is upside now. On an EBITDA perspective, the upside will be a double. And you can see that here as well. 600 million AUD enterprise value. And when we discount the whole timeline at 10% discount rate, which is pretty high, then we get to 1.7 billion NPV. That's a double. So I think this company can be a double if, that's a big if they can get in production by 2026. That's the risk. Can they get in production without capex overhang? Because this is very high capex. Let's say we have 30% capex overhang times 130%, then you can see that the cash flows will be much less, to 1.5 billion, which is still a double. Let's say capex overhang of 50%. Yeah, then it's lower cash flows then, and still a double in the long run because it's such a big mine life. So I do like this project. But what if their production is not what they say? We already saw that here, that they didn't achieve their production guidance. They also didn't achieve their cost guidance. So the cost could be higher. Let's say the costs were 1300. Then yeah, it goes down a bit, but still pretty good project. Yeah, not bad. I like this project. I don't like the jurisdiction. So I think we have analyzed this company. Let's see if the presentation has something else. Oh, here is the production profile. Let's see if we have the correct numbers here. 233. Yeah, let's assume they have delays of 1 year. 233. And then 200. Yeah, it's almost the same up to 242. Okay. So basically, this is what we will get. After tax NPV is 1.5 billion. Yes, that's around 1.5 billion. But they're just in construction yet. Will take 2 years. And Tuga, nothing is being done with Tuga. 600. Yeah, that has 1 million ounces as well. Kiaka is a pretty big mine, 7 million ounces. 8 million ounces. I don't know where they got this from, but last time I looked at it, there was no Kiyaka, and now suddenly that pops up. They probably bought it or something like that. But anyway, this looks great. Now, is it better than Soma Gold or not? That's the question. Compare this chart with this chart. Should we sell Soma Gold for that other mine? What's the enterprise value of Soma Gold right now? 64 plus 25. Actually, this is already 0.65 probably. 66 plus 25, that's 90 million. So here we are already at 90 million. So you get your money back in 3 years, not 2 years anymore because the share price has gone up. And then we still have upside around double and then further upside triple. But you can see here the cash flows will keep coming in. While at West African Resources, the cash flow is negative first because they need to build something with 600 million capex, and then cash will come in and you get your money back only in 2030, 7 years, and then we go up by a double. So I still think that this is too long, too far away in the future. I want my cash flow right now, not in 10 years. So this is much better because you get your cash in 3 years and then there's still upside. Because this is going to 100,000 production eventually with all the exploration that they're doing and the mill expansions that are coming. So this can easily go up much more. So I should stay with Soma Gold still. PE ratios of 30 to 40, so that's 2 times PE ratio. Yes, 2 times, and with West African 350, 400, 1.5 PE ratio in the future, in 2026. That's also good. 2 times PE ratio. So both very good projects, only that this one has a lot of capex to digest. Okay. So that was the video about West African resources. And I'll see you in the next video. Bye.